This LOS is define an exchange rate and distinguish between nominal and real exchange rates and spot and forward exchange rates. Okay, before we jump into this LOS, we'll start with a bit of an introduction because we're heading into the foreign exchange section now. So measured by daily turnover, the foreign exchange FX market, the market in which currencies are traded against each other, is by far the world's largest market. Current estimates put daily turnover at approximately US $4 trillion for 2010. So that's a pretty old figure from the text. This is about 10 to 15 times larger than the daily turnover in global fixed income markets and about 50 times larger than global turnover in equities. Moreover, volumes in FX turnover continue to grow. Some predict that daily FX turnover will reach 10 trillion by 2020 as market participation spreads and deepens. So the FX market is also a truly global market that operates 24 hours a day, each business day. It involves market participants from every time zone connected through electronic communications networks that link players as large as multi-billion-dollar investment funds and as small as individuals trading for their own account, all brought together in real time. International trade would be impossible without the trade in currencies that facilitates it, and so too would cross-border trade capital flows that connect all financial markets globally through the FX market. So continuing with the introduction, these factors make foreign exchange a key market for investors and market participants to understand. The world economy is increasingly transnational in nature, with both production processes and trade flows often determined more by global factors than by domestic considerations. Likewise, investment portfolio performance increasingly reflects global determinants because pricing in financial markets responds to the array of investment opportunities available worldwide, not just locally. All of these factors funnel through and are reflected in the foreign exchange market. As investors shed their home bias and invest in foreign markets, the exchange rate, the price at which foreign currency denominated investments are valued in terms of the domestic currency, becomes an increasingly important determinant of portfolio performance. Even investors adhering to a purely domestic portfolio mandate are increasingly affected by what happens in the foreign exchange market. Given the globalization of the world economy, most large companies depend heavily on their foreign operations. For example, by some estimates, about 40% of the S&P 500 index earnings are from outside the United States. Almost all companies are exposed to some degree of foreign competition and the pricing for domestic assets. Equities, bonds, real estates, and others will also depend on demand from foreign investors. All of those various influences on investment performance reflect developments in the foreign exchange market. The foreign exchange market. We'll start by looking what an exchange rate is. And an exchange rate is the price of the base currency expressed in terms of the price currency. For example, a US dollar over euro rate of 1.3650 means the euro, the base currency, costs 1.3650 US dollars. So P to B, referring to the price of the base currency, B expressed in terms of the price currency. Okay? So just to be clear, the denominator is always 1, and the numerator in this case is 1.3650. So the two ways to look at it is that 1 euro costs $1.36, 1.365 US dollars, or if I have 1 euro, I will be able to convert it to 1.3650 US dollars. So just remember that the denominator is always 1, okay? So the spot exchange rate is usually for settlement on the second business days. I have seen practice questions on that after the trade date, and that's referred to as T+2 settlement. So a dealer might quote a two-sided price on the spot US dollar euro exchange rate of 1.3648/1.3652. This means that the dealer is willing to pay US dollar 1.3648 to buy 1 euro, and that the dealer will sell 1 euro for 1.3652. So that's obviously buy rate, and that is the sell rate, okay? That's how it's, or bid or ask. The offer price is always higher than the bid price. The bid-offer spread, the difference between the offer price and the bid price, is the compensation that counterparties seek for providing foreign exchange to other market participants. And if you have ever changed money in the airport, you can see that the bid-ask spread is quite huge, which is why you should seldom do that. The counterparty in the transaction who inquires for a two-sided price quote will have the option, but not the obligation, to deal at either the bid to sell the base currency or offer to buy the base currency price quoted to them by the dealer. The inquirer can pass on the price quote, but if the inquirer deals, the jargon in the market is that this counterparty has either hit the bid or paid the offer. Okay, here's a fairly important slide. It comes up a little bit later in the reading, but I thought I'd get this, put it in front and center really early because it's really important. So first of all, we've got three columns here. The first column is the FX rate quote convention. Number 2 is the naming convention. And then 3 is the actual ratio, the price currency to the base currency. So it's fairly important that you understand the rate quote convention, the naming convention, and the actual price ratio, okay? So I'll show you one little trick here. You can see some of them are called the euro. So the naming convention is the euro. Well, that's US dollar in the numerator, euro is in the denominator, okay? But if it's dollar yen, you can see that the second currency is the numerator and the first is the denominator. So let's look if that holds. US dollar Canada. Yes, Canada is in the numerator, US dollars in the denominator. Let's look here, euro yen. Okay, yes, euro is in the denominator, yen is in the numerator. Euro sterling, euro in the denominator. Euro Swiss, euro in the denominator. Sterling yen, sterling is in the denominator. So you can see that the first word is the denominator and the second currency is the numerator. So that's just the way that I like to memorize it. You can see here euro Canada, the euro's in the denominator. Canada yen, aha. So the first word is the denominator, so you can see the Canadian dollar is in the denominator, okay? Here we had dollar Canada, and so the US dollar is in the denominator, and the second one is in the numerator. So that's the way that I kind of keep it straight. You just have to remember the first is the denominator, and the second is the numerator. And then I think you'll get it straight. And then the way to remember it for where there's only the naming convention where you only have one word, like the euro, or the sterling, or the Aussie, or the Kiwi, okay, or the Swiss franc. So as I said, when you've got two currencies, the first one's always the denominator, the second one's the numerator. And with the naming convention, when there's only one, like the euro, or the sterling, or the Aussie, or the Kiwi, or the Swiss franc, you can see here that for the euro, the numerator is always the US dollar, and the currency is the denominator. Sterling, the numerator is US dollar, and the Great Britain pound is denominator. Aussie, the numerator US dollar. Kiwi, numerator US dollar. Aha! Swiss franc, we have one here that's different. It's the Swiss franc in the numerator, and the US dollar is in the denominator. So that's something really to be on the lookout for. Otherwise, our method does work. So again, the euro yen, first word is the denominator. Euro sterling, denominator. Euro Swiss, euro's the denominator. Sterling yen, Great Britain pound is the denominator. Euro Canada, euro's the denominator. Canada yen, Canada's the denominator. Okay? So it's fairly important to try to get up to speed on the naming conventions and which currency is in the price and which is in the base, okay? And a couple of rules hold, but the Swiss franc sort of stands out as being a bit of an anomaly because the US dollar is not in the numerator. Yes, so we just did that last slide on the conventions for the naming convention and what currency is the price and which currency is the base, because that leads into the next point, which is really important to understand the difference between a direct currency quote and an indirect currency quote, okay? So now we're moving from price currency to base currency to another naming convention where we talk about the domestic currency and the foreign currency, okay? So you can see a direct currency quote takes the domestic currency as the price currency and the foreign currency as the base currency. So we can hear S is talking about spot rate. So the nomenclature is S, D to F. So you just have to memorize that a direct quote, and I guess the way that I like to do that, D direct, D is in the numerator. Start with the D up top, okay? So a direct quote, S, DF. And an indirect quote, all you're doing is you're putting the domestic currency as the base, so it's the opposite. So I like to think of it as DD, direct, and that's your numerator, and then you'll get it straight, okay? So to convert between the direct and indirect quotes, the inverse or the reciprocal is used. Professional FX market use standardized conventions for how the exchange rate for specific currency pairs will be quoted. And that's why I started with that slide and then led into this slide. You have to know that professional FX market use those standardized conventions, those naming conventions, and which currency is the price and which currency is the base, okay? So currencies trade in foreign exchange markets based on nominal exchange rates. So that's getting back to the LOS, asking about what a nominal exchange rate is. Currencies trade in foreign exchange markets based on nominal. The real exchange rate is defined as the nominal exchange rate multiplied by the ratio of price levels, and that measures the relative purchasing power of the currencies. An increase in the real exchange rate, and you can see here it's domestic over foreign, implies a reduction in the relative purchasing power of the domestic currency. And we'll see more of that a little bit later, okay? Okay, we're going to go through some rules here, and we're going to start here with a direct currency quote. Takes the domestic currency as the price currency and the foreign currency as the base currency, okay? So you can see here I'm Canadian, so I've just put down here, here's the CAD, the dollar Canada, so we can see we have CAD over USD, okay? And that would be domestic over foreign from the point of view of me as a Canadian. So what I like to do when you get multiple choice questions like this, don't try to think it all through your head and just do a quick little calculation or an example, write it down, and then match up the wording. And so I'm going to show you what I mean by that. So it says an increase in the exchange rate. So if you've got CAD over US dollar, so remember, I'm going to put 1 in the denominator, and in the numerator right now, 1 US dollar is equal 1.34 Canadian dollars, correct? So if I have 1 US dollars, I'm going to get $1.34 Canadian, or it's going to cost me $1.34 to buy 1 US dollar, correct? So if we have an exchange rate that's quoted in the direct terms, an increase in the exchange rate, so let's say that increases to 1.38, well, that means 1 US dollar is going to get me $1.38. That means that the domestic currency is depreciating because it's going to cost me more to buy that $1 US, okay? So you can see in this case, when you're talking about a direct currency quote where you've got the domestic over foreign, if it's increasing, then the domestic currency is obviously depreciating. Now, if there's a decrease in the exchange rate, let's go to this side, and it goes down to $1.30 over 1. So there's a decrease. You can see $1 US now only gets me $1.30 Canadian. It's getting me less Canadian dollars. The Canadian dollar has become more expensive, so it means that the domestic currency is appreciating, okay? So often when you're reading through this FX stuff, if you're just reading the rules, it can be a little bit confusing, but if you put it to your numerator and denominator, and remember that the denominator is only 1, and then you're saying, oh, am I getting more of the domestic currency, or am I getting less of the domestic currency, which is becoming more expensive or least expensive, and then appreciating or depreciating, okay? And that's the way to do it. So the indirect quote is going to use the domestic currency as the base. So it's just the reverse then, an increase in the exchange rate quoted in indirect terms means that the domestic currency is appreciating. And a decrease in the exchange rate quoted in indirect terms means that the domestic currency is depreciating. So it's very important. As I said, what was the rule that I said? Direct quote, DD. I'm going to have spot, put the D in the numerator over the foreign. Indirect, well, I'm going to reverse it, F over D. Then always remember the denominator is always 1. Put your numerator, if it's going up, it's going down. And then just think getting, am I buying more or less of the currency in the numerator? And therefore, which currency is depreciating or appreciating, okay? Not too difficult. It just takes a little bit of practice. So let's do a quick practice question to check our understanding. An exchange rate, A, is most commonly quoted in real terms. B is the price of one currency in terms of another. Or C, an exchange rate between two currencies ensures that they are fully convertible. That shouldn't be too difficult. The correct answer is B. An exchange rate is the price of one currency in terms of another. So you've got the price in the base, and that's why we say it's the price in the numerator. So it's the price of one currency in terms of another, which is the base. So the exchange rate is the number of units of the price currency that one unit of the base currency will buy. So as I said, I make the denominator 1. Equivalently, it's the number of units of the price currency required to buy 1 unit of the base currency. Okay, not a lot new on this slide. We're just going to reinforce some key points. So currency are referred to by their ISO code. So you can see currencies have a 3-letter code: US dollar, CHF, Swiss franc, that's Confederation Helvetia, Euro, the CAD, we've seen that, Aussie dollar, AUD, etc. So that's number 1. Number 2, the exchange rate is the number of units, one currency, the price currency, that one unit of another, the base currency, will buy. So again, this is just a review. So the convention for exchange rates, and in this case, we're just doing A over B. It's the number of units A that one unit of B will buy. So remember, I said make the denominator 1, okay? So 1 unit of B, the base currency, will buy how much A, okay? So A is the price currency, B is the base. It's always price to base here, okay? So again, we talked about the CAD, the Canadian dollar, which is dollar Canada, okay? And as we said, that's US dollar to Canada. The first word is the denominator. The second was the numerator, remember? So here we have a quote, CAD over US dollar. So again, always do it like this, 1.33581, which, as I said, the 1.34 with a little bit of rounding. So that's how we would look at it. We've got the Canadian dollar in the numerator. That's how much Canadian dollars 1 US dollar will buy. Or conversely, if I had $1.33, $1.34 Canadian, it'll buy me 1 US dollars. So that means 1 US dollar will buy 1.33581 CAD dollars. So again, you can see if this exchange rate falls to 1.25, if the exchange rate falls, what's happening? 1 US dollar is buying me less Canadian dollars. It means that the Canadian dollar is appreciating and the US dollar is depreciating, okay? So again, if you get a question with regards to FX and it's all words, do your numerator, do your denominator, see what's going up, see what's going down, and then figure out which currency is appreciating or depreciating. So this was just meant to be a quick little review summary slide. Oh, so we're carrying on now. And again, this slide is a bit more review and reinforcement because with the FX, it just takes a little bit of practice. So now we're reviewing again the domestic currency quote and the indirect currency quote. So what did I say? I said DD. So you can see it's always price in the numerator, base in the denominator. So for a direct currency quote, what did I mean by DD? It means the spot rate. The D is in the numerator and the foreign is in the denominator. So that's our direct quote. And the spot for an indirect quote, you're just going to change it. The foreign currency is in the numerator and the domestic currency is in the denominator. So just remember DD, direct, D in the numerator, okay? So here, I'm just going to go through a little bit of an example. So I took off the XE currency converter just to show you 1 euro equals 1.07627 US dollars. This was just a quote from the other day. And so I'm showing here, consider the quote US dollar over euro. So remember, we're going to make the denominator always 1. And in this case, the numerator is 1.07627. That means 1 euro is going to buy me $1, 1.07627 US dollars. Okay? So the base currency is the euro. That equals the 1. The base is always 1. And the price currency is the US dollar. So the US dollar over euro is a direct currency quote from the US perspective. Okay? So this is the issue with some of these questions, is that they give you the perspective of who the investor is. So it's a direct quote from the US perspective, because the domestic currency, US dollar, that's domestic to me if I'm a US person, resident residing in the US. So that's the next thing that you have to understand. And the US dollar euro, it's an indirect quote from the euro perspective. Okay? So I'm a European. It means that from my perspective, the foreign currency, the US dollar, is in the numerator. Okay? So that's the other thing to understand, is it's from the perspective of the investor. So from the euro perspective, we can convert the US dollar euro into the direct quote by inverting. So this is what we were talking about in terms of the reciprocal or the reversing. So now to get euro over US dollars, we just do 1 divided by 0.07627, and we're going to get 0.92193. Okay? So again, that would be 1 US dollar, because now we have the US dollar in the denominator. 1 US dollar is going to buy me 0.92913 euros. So now we're spending a bit more time on what the real exchange rate is. And the real exchange rate is an exchange rate that has been adjusted for the relative purchasing power of the two currencies' home countries. So again, I just put here in green that quoted exchange rates are nominal exchange rates. And we calculate real exchange rates by adjusting the exchange rates for the relative price levels of the countries in the pair. So you can see here the real exchange rate, we've got D over F equals the spot, D over F, times, you got to be careful here, it's the price of the foreign over the price to the domestic. Okay, so that's a formula absolutely you have to memorize. So you can see here the real exchange rate using Aussie dollar and US dollar is the spot rate adjusted for the relative price levels. So again here, real exchange rate, AUD over USD. In this case, so it's the spot rate, D over F, times the P over F times P over D. Okay? So you can see that's why you need to be careful here. What's in the numerator? It's the US dollars. Okay? So this domestic, that's from the point of view of the Aussie dollar, from the Australian obviously, if we're talking about the Aussie dollar as the domestic. So it's the spot, D over F, times the relative price levels, but in the numerator, it's the F. That's all you need to remember, okay? So again, it says S, AUD over USD is the nominal or spot exchange rate. So again, that's the rate that's quoted in the quoted exchange rates, are the nominal rates. And so here, PUSD over PAUD is the relative price level. And sometimes we'll see in other texts or in the other sections that they don't just use P, they use CPI, which is the consumer price index level, okay? Okay, this is a very useful slide, and you can see that the multiple choice questions can be really wordy, you know, increasing, decreasing, most likely, least likely. So again, you've just got to get your, when you're answering these questions, I like to write things out and then look at my notes as if I'm recreating my notes or my flashcard, my memory notes, and then I look at the question and I match it up. So you've got 90 seconds, that's the best way to do it. So again, when we're looking at the real exchange rate, I know the formula, it's the spot D over F times P over F over P over D, okay? So I'm gonna write that out, need to know that. And then when they're talking about increasing or decreasing, most likely, least likely, I'm going to read through what the sentence is saying and compare it to my formula. And I'm thinking, what's happening to my numerator? What's happening to my denominator? And then I'm going to work through it. So you're going to see how that works here. So you can see an increase in the real exchange rate. So the real exchange rate equals this, okay, spot times the price of the foreign. So if that's going to increase, it implies a reduction in the relative purchasing power of the domestic. Why? The denominator is going down. That means a reduction in the relative purchasing power. If the denominator is going down, then this second equation is going up, and that's going to increase my real exchange rate. And that's the way that I'm going to analyze and answer these questions. Then it becomes really easy. You just have to remember what the formula is, understand what the numerator denominator is, and then just understand that increase in the real exchange rate, it means that the denominator is going down. That's a reduction in the relative purchasing power of the domestic currency. Okay, so you can see here a decrease in the domestic price level. So they're just spinning the words a little bit. A decrease in the domestic price level increases the real exchange rate. So again, I'm decreasing the denominator, which is the domestic price level. That's going to increase the real exchange rate. So they can talk about here the increase in the real exchange rate, or they change the sentence to a decrease in the price level. Okay? So again, just spinning it then, a decrease in the real exchange rate implies an increase in the relative purchasing power of the domestic currency, and an increase in the domestic price level decreases the real exchange rate. So, on first blush, if you're reading through these sentences and trying to memorize the rules, that's not the way to do it, is to look at the formula, understand the numerator and denominator, what's going up, what's going down, and how does that impact the R. Then this whole slide becomes really easy to understand. Very important slide. So a quick little practice question to show you exactly what I was talking about. A decrease in the real exchange rate, quoted in terms of domestic currency per unit of foreign currency, is most likely to be associated with an increase of which of the following: A, foreign price level, B, domestic price level, or C, the nominal exchange rate. Okay, so you see the way that I'm going to solve this? First of all, I'm going to write the formula. The real exchange rate, and that's D over F, equals the spot, D over F, that's direct, times the price level, CPI or P, and that we have to put the foreign in the numerator over the P over D, okay? So it says a decrease in the real exchange rate. So I know the left-hand side is going down. How is that going to decrease? I know that my price domestic is going to increase, correct? I need to make my denominator go up to make this equation come down, okay? So then, or it might be talking about the foreign level price. That would also have to be going down relative to the domestic. So is it an increase in the foreign? No, that's wrong. If the increase in the foreign is going up, the numerator is going up, that would make the real exchange rate go up. Is it an increase in the domestic? Yeah, it has to be, right? Or is the nominal exchange rate? No, we're not talking about the nominal exchange rate at all. We're talking about the relative prices, okay? So B is correct. The real exchange rate, quoted in terms of domestic currency, is given by the formula that I've just given you. And I've given you the rules here as well. A decrease in the real exchange rate implies an increase in the relative purchasing power of the domestic currency, and an increase in the domestic price level decreases the real exchange rate because it implies an increase in the relative purchasing power of the domestic currency. So again, an excellent practice question relating 100% to how I'm going to solve this type of problem. And if you understand the formula, real, domestic over foreign equals spot, domestic over foreign, times price over foreign over price with D, and you'll understand what's going to drive the increase or decrease in the real exchange rate through the prices, relative prices of the foreign or domestic currency. These questions become really easy, actually. So we'll do another quick practice question. What will be the effect on a direct exchange rate quote if the domestic currency appreciates? A, increase, B, decrease, or C, no change? Okay, this is an excellent little question. I'm going to show you the way that I work through it by using, by writing out my numerators and denominators, putting a few numbers in. I've got 90 seconds, and just making sure that I don't make any mistakes. Because in the test, when the adrenaline's going, most likely, least likely, increasing, decreasing, don't try to think it all out. Work it out, okay? You've got some space here on the page to do your little calculations. So again, it says direct exchange rate. So I know DD, the rule, domestic over foreign. I'm Canadian, okay? So I like to put my CAD over my US dollar. Then I know that right now I get a $1 US will get me $1.34 Canadian with a little bit of rounding. Then I read the question. It says if the domestic currency appreciates, what's going to happen to the numerator? It means $1 US is going to get me fewer Canadian dollars. So it's going to be 125 over 1, correct? It takes me less Canadian dollars to buy that $1 US because my Canadian dollar is appreciating. So what's going to be the effect on the direct exchange rate? It's going to be B. It's decreasing. It went from 1.34 to 1.25. So again, I'm not going to think through the rules or memorize the rules. I'm going to work through my logic, and this question becomes so easy. It's not increase. It's not no change, obviously. It's B, decrease. But do you see how I did that? I stick with one example. I'm Canadian, so D over F. I always use the CAD in the numerator. Appreciate, depreciate. It said appreciating. That means $1 US is going to buy me less. Boom, it went down from $1.34 to $1.25. So B is correct. In the case of a direct exchange rate, the domestic currency is the price currency, the numerator. Foreign currency is the base, i.e. the S, D over F. So if the domestic currency appreciates, the fewer units of the domestic currency are required to buy 1 unit of the foreign currency, and the exchange rate, domestic per foreign, declines. So again, these questions become really easy with a bit of practice, but work through your examples. Whatever your home country is, use that exchange rate, work your way through it, because they could easily change this to indirect. Then I always think, well, how could they change this question? They could change it to an indirect quote, and then the answer would clearly be A and not be B. And again, so you just have to remember direct, D over F. If it's indirect, it's going to be F over D, and it's going to be the opposite. Great little question. Another practice question. An executive from Switzerland checked into a hotel room in Spain and was told by the hotel manager that €1 will buy 1.2983 CHF, which is the Swiss franc. From the executive's perspective, an indirect exchange rate quote would be A, 0.7702 euros per Swiss franc, B, 0.7702 Swiss francs per euro, or C, 1.2983 euros per Swiss franc. Okay, I'm going to work through this question, the solution really slowly. On an exam, I think you would get this right really quickly. But nevertheless, let's start with it. So again, it's bringing in not only the exchange rate in terms of direct or indirect quote, but also from the perspective of the individual. Okay, so the executive's from Switzerland. So from his point of view, the CHF is the domestic currency, and the euro is the foreign currency because he's from Switzerland. Okay, so remember a direct quote. I'll always spot. Direct quote would be the domestic over the foreign. So that would be CHF over the euro, okay? And so that is our direct quote. And our indirect quote would be, that's D over F. Our indirect quote would be our foreign over our domestic, and that would be our euro over our CHF, okay? And that's the way that we started. And then we're given an exchange rate here. €1 would buy 1.2983. So again, if I start with my direct quote, 1.2983 divided by 1, okay, that gives me my CHF over my euro. So if I move that to a direct quote, I'm going to have €1 in the numerator divided by 1.2983. I'm going to bring up my calculator. I'll just move it over here so you can see the question a little bit better. Okay, so I'm just going to do 1 divided by 1.2983, and I'm going to get 0.770238. So I just need to be careful here because they're giving me 0.722 euros per CHF. That is the correct one. 0.722 Swiss francs per euro? No, that's not right because I can see €1 is going to give me 1.29. So actually that one's immediately, you can see that is wrong. And C as well, 1.2983 euros per CHF? No, again, I can see. So actually I didn't even have to do the math. That's why I told you this question is really so easy. If I understand the reading, I can see it's not 1.2983 euros. It's 1.2983 Swiss francs per euro. But again, I walk through that step by step just to show you the direct quote, the indirect quote, and how the indirect quote is the reciprocal of the direct quote, and it gets you to the correct calculation that we're going to get 0.7702 euros per 1 Swiss franc. Okay? So excellent little question. So again, another quick practice question. All else equal, an increase in the nominal AUD over HKD exchange rate, that's Aussie dollars over Hong Kong, will lead to an increase in the AUD denominated value of your foreign investment in Hong Kong. This is A, correct, B, incorrect, because based on the quote convention, the investment's value would be decreasing in Aussie dollar terms, or C, incorrect, because the nominal Aussie dollar value of the foreign investments will depend on movements in the Australian inflation rate. Okay, this question should not be too difficult. So we're given here the nominal AUD over Hong Kong dollar, okay? And it says that nominal exchange rate is increasing. So what's happening if that's increasing? Again, let's say that was going from 1.20 to 1.25. That would mean the Hong Kong dollar, and I may, on the test, I may not know what the exchange rates are. It doesn't matter. I'm just going to use, again, something like this. So 1.20 to 1.25 means it's going up. If that's going up, that means that the Hong Kong dollar is appreciating, so that the value of my investment in Hong Kong in Aussie dollar denominated value is going to increase, okay? So that should be a fairly easy one. A is correct. Given the quoting convention, an increase in the AUD HKD rate means that the base currency, Hong Kong dollar, is appreciating. 1 Hong Kong dollar will buy more Aussie dollars. This is increasing the nominal value of the Hong Kong denominated investments when measured in AUD terms. Another practice question. All else equal, an increase in the Australian inflation rate will lead to an increase in the real exchange rate, Aussie dollar over Hong Kong dollar. A higher real exchange rate means that the relative purchasing power of your Aussie dollar denominated income is higher. This is A, correct, B, incorrect with respect to the real exchange rate only, or C, incorrect with respect to both the real exchange rate and the purchasing power of the Aussie dollar denominated income. Okay, this is an excellent question, and it shows you that you see, we don't have any calculations here. There's no numbers. There's just a lot of words. And so you have to remember the formulas. When you write it out and think of what's happening to the numerator denominator, then you're going to be able to answer whether it's correct, incorrect, most likely, least likely. And sometimes here you've got, in the CFA, they're asking you on more than one statement, okay? So let's just start by writing it out. We know that the real exchange rate equals the spot exchange rate. In this case, we've got the Aussie dollar over the Hong Kong dollar, and it's times the relative purchasing power. We had to remember here that we put the price of the foreign in the numerator. We've seen that earlier. So we're putting the Hong Kong dollar in the numerator over the price of the Aussie dollar in the denominator. That's the key thing that you have to absolutely understand. So it's saying an increase in the inflation rate in Aussie or CPI. That's going to increase your denominator there. If I increase my denominator, what's going to happen to the real exchange rate? It's going to go down, okay? And it's saying here will lead to an increase. No, that's wrong. It's going to lead to a decrease, okay? So immediately, I've read the question. I've worked out my formula. Then I go back to read it, and I see, aha, no, they're giving me a mistake there. So A is not right. That can't be correct, okay? And then it's incorrect with respect to the real exchange rate only. Aha, it's a two-part thing. So now I need to read the second half. It says a higher real exchange rate means that the relatively purchasing power of your Aussie dollar denominated income is higher. No, it's going to be lower because the exchange rate has gone down. So my Aussie denominated income is going to be lower, okay? So B is incorrect as well, because actually the second statement is wrong. So it's incorrect with respect to both the real exchange rate and the purchasing power of my Aussie denominated income. So C is correct. An increase in the Aussie Australian domestic inflation rate means that the real exchange rate would be decreasing, not increasing. Moreover, an increase in the real exchange rate would be equivalent to a reduction in the purchasing power of the Australian client. Goods and services denominated in the Hong Kong dollar would cost more. So a very good question. Lots of words, 2 sentences, and just work through your formulas, numerator, denominator, what's happening to the real exchange rate, and you should be fine. But you can see this type of question definitely takes quite a bit of practice. Another practice question. This has been a very long LOS, but to get up to speed on the foreign exchange, this is what it takes, okay? So all else equal, a decrease in the nominal exchange rate, Aussie dollar over Hong Kong dollar, will decrease the real exchange rate and increase the relative purchasing power of your Aussie dollar denominated income. This is A, correct, B, incorrect with respect to the real exchange rate, or C, incorrect with respect to the purchasing power of the Aussie dollar denominated income. Okay, this question is not too difficult. So again, we just have to remember the real exchange rate is the spot, which is the Aussie dollar over Hong Kong dollar, times the price in the foreign, which is Hong Kong, over the price, the domestic, okay? So you can see here it says that the nominal exchange rate here is decreasing. Well, if the nominal exchange rate is decreasing, the real exchange rate is going to decrease, okay? And it's going to increase the relative purchasing power of your Aussie dollar denominated income. And that is correct, because as the spot Aussie dollar Hong Kong dollar exchange rate decreases, the Hong Kong dollar is depreciating, okay? Because remember, what's happening here? Let's just put in some numbers. So if that is the nominal rate is going down, if I had 1.25 to 1, now it's going to 1.20 to 1. It means that 1 Hong Kong dollar is buying me less Australian dollars. It means the Hong Kong dollar is depreciating. So it means that my purchasing power of the Aussie dollar is increasing, okay? So this is reducing the real exchange rate based on this formula, and it's also increasing the Australian client's purchasing power. So again, quite a good question. These take a little bit of practice. And we're down to the last slide for this LOS. It's been a long one, but I think we've accomplished a lot, okay? Maybe we've gone above and beyond the call of duty for this LOS, but seeing as we've jumped into the foreign exchange, I think we've really tackled it to a good level. So recall the LOS is define an exchange rate, distinguish between nominal and real exchange rates, and spot and foreign exchange. We're going to see more on forward exchange rates and some calculations in further LOS. So for this one, we're just going to leave it at the definitions. And a spot exchange rate is an exchange rate for an immediate delivery, that is exchange of currencies. And a forward exchange rate is an exchange rate for the exchange of currencies at some specified future point in time. In the derivatives, we're going to look at futures and forwards. And as I said, with regards to this foreign exchange reading, we're going to look at forwards in more detail in some LOSs that are coming up. But for now, that's the last slide for this LOS. It's been a long one. Thank you.